What's up, everybody? Zach is back with another episode of Journey to $1 Million, and you guys know what time it is. Time to pull up the prostockedadvice.com/blog on your computer screens, tablet screens, or phone screens. And hopefully they're iPhone screens or MacBook screens, because we need Apple stock to go up right now. Apple stock is lagging behind, and our leaps are suffering a little bit. But hey, nevertheless, yesterday was a pretty good bounce for SPY and Triple Q at the end of the trading day. Overall, it was a pretty choppy day. But if the major indices do keep up this bounce and this rotation back into tech, then I think that we could see a pretty good move into next week. And a lot of triggers will be triggering next week as far as some short-term calls. But this week has been way too choppy. I mean, Monday to Wednesday was just bleeding, suffering. But then Thursday we saw a little bounce up, and this is a chart of the Triple Q, which is NASDAQ 100, and it actually bounced nicely off of the 50-day moving average. Of course, we could see it keep falling, and I mean, your guess is as good as mine. But the thing is, the jobs report just came out, and the jobs report was looking like we missed. And not only did we miss, but we missed by far. We expected 1 million jobs to be added, and only 266,000 jobs were added. And you know what? I first got the notification on my phone, and I was like, well, it's going to be a bad Friday. And then next thing I know, I checked the futures, and NASDAQ is gapped up 1.5%. So yes, your guess is as good as mine. Seriously, you cannot make this stuff up. It's pretty funny. I mean, rationally trying to decipher the code, you would think that, well, the priced in is priced in, and then we sold the news and the rumor and then all of that stuff. But yeah, sometimes it has a mind of its own. But the good news is Triple Q is up 4%. Soxel's almost up 4%, and this is pre-market still. We have about 15 minutes until the market open. But anyways, Tesla, GEVO, I would like to update you on these plays. And these are my tech swing plays. The Tesla was a longer term. GEVO was so far a shorter term for me. I just got into it, but of course we'll see how long I will be holding it. GEVO got smashed. Tesla was a little bit. But specifically GEVO, and GEVO I didn't ever put very much money into. I think I've got 100 shares now, which is still less than $1,000. I think my cost basis is around 6 something. But anyways, last week it was $7.40. Now it's down to $5.83. It's gotten hammered into the plank of wood. But hey, only a couple days it could bounce back up to $7.50, $8. So I'm not really so worried about that. These will swing. These are volatile. It is a very small growth innovation company. Of course, they're in renewable energy, but you get my point. So this one will swing, so I'm not so worried about it. Can dollar cost average more? It looks like it is on the support right now. It seems like a good 0.2 dollar cost average more into. And also, I would like to mention that the Cathie Wood ETFs are basically all down except for the ARC-Q, the robotics one, and the ARC-X, which is the space one. I'm considering to roll mine out because I pretty much have a leap on about every one. And I dollar cost average through the last dip, so now I'm thinking that I will need to roll instead of dollar cost averaging more. Just happens like that sometimes. I'm not opposed to rolling it. I thought about rolling before, and I think it might be the time to roll now. Which rolling is, if you don't know, is just selling for a loss your position, or it could be for a gain. But usually you do it when you're losing in the position. You need more time, or you need a further way or a closer strike price. So basically we would cut the position and then we would rebuy further out. So if we have 7 months left on the contract, we could sell it for $1,000, let's say, and then we could buy another $1,000 one that is further out, maybe 12, 13 months, something like that. So that would be rolling the position. Some brokers, you can do this automatically, just click like a roll button. Some you have to manually sell and then reopen and buy it again. But just to let you guys know, I am thinking about rolling it and maybe even reallocating the capital, because I am not the one that won't cut positions for a loss. Like, I don't have a hard time doing it. And it doesn't really hurt me overall. It doesn't affect me mentally, psychologically, or financially, because I make sure I don't put too much into a position. I am very well diversified, so I'm okay. And it's like my GEVO, like, yeah, okay, whatever. I only have 100 shares anyways. And maybe 100 shares to some of you guys is a lot, maybe it's not. And if it's a lot, maybe you should only buy 10 shares of it. And it doesn't matter how X amount of dollars you want to invest in this position, you invest no matter how many shares it is. So yeah, I mean, it's overall is just be diversified. Don't put too much into a position. No more than, I think the rule of thumb is about 3% into one position. Sometimes I do 5, just depends. And sometimes a lot less, especially like GEVO. But anyway, so it's okay. Like, I will cut the position sometimes because I see some things that are better. So yeah, sure. ARK I see as a long-term play. Yeah, if it takes 5 years for these, could 5x. But maybe 1 year, they're going to 0x. 1 year, 1x. I mean, trading at $140 now, maybe 1 year later, it's still going to be at $140. But then the second year, the third year, the fourth year, fifth year, it could just go to the moon. But see, that doesn't really make sense to hold the money in something that's not going to move for the first part. You can always buy and sell. I mean, these are the brokers. They don't cost anything to buy and sell positions. They're free trading. So I mean, there's no problem doing that in my point of view, and I don't shy away from that. So if I see something that is moving up now, then I'll put the money in that. And if I think that I can always come back and revisit these things. And of course, I'm not going to cut every single one altogether, but I might start downsizing. Maybe by half and then rolling some out. I don't know. Anyways, I'm going to think about it. Of course, ARK is already gapping up 3% today. So we'll see how it goes. It is hitting a support right now, and I guess I can go ahead and show you guys that. Let me make sure I'm sharing this screen. So the support, it's here. From the last time. I mean, it's right on the button. So yeah, yesterday it hit that, so we'll see. I mean, it's gapped up 2.7%, so almost 3%, which is not much considering the past week what it's gone down, but still showing some signs of life, which is better than not. So we'll see how it goes, but I am definitely considering to switch some things around. Now, you might be asking me or yourself, what am I considering buying into with this to reallocate the capital with? Well, there are 3 ETFs that have done really well for me, and I'm thinking about putting more in them. The first one is UDOW. So this is a 3X Dow Jones Industrials ETF. So it is a leveraged ETF. It's a 3X. And it has been one of my best performers over the past year. So, you know, the same with TQQQ, did really well in the beginning, the middle of 2020. But Dow, the Dow one has done well this year in 2021. They're all pretty much evened out, like the S&P 500 3X and the Dow Jones 3X. I mean, it's all pretty much even, considering the different times. But specifically for this year, 2021, Dow Jones is doing good. I mean, if you just consider the graph here, it is doing super well. It's trading well above the 50-day moving average. I don't really see any big reason why that's going to change. Of course, I do believe that all the markets will, and the indices will continue moving up through the summer, probably pull back after the summertime, and then continue its way up through the end of this year. And that my stance hasn't changed on any of that. But the Dow has done well because of the transition into cyclicals, the falling tech. It's going to keep the Dow up. I mean, if one day the NASDAQ is down, usually Dow is up. One day Dow is up, usually NASDAQ is down. I mean, if you look at the futures right now, NASDAQ and S&P is up, tech is up, the FANGs are up, and Dow is down. So, I mean, that's just kind of how it's been working. So this has been a really good buy for my portfolio. It's really hedged against some of the falling tech over this first 4 or 5 months of this year. So it's been a really good position for me, and it's pretty much going up. It's going up. So I think that if you do have some to allocate to UDOW, I think it's interesting. Of course, you can just do a Dow Jones ETF like DIA or something like that. But I think it's a little bit boring, in my opinion. I think it's boring. I don't like those. Those don't really move very much. Like one day, if it goes up 0.25%, I don't really get out of bed for 0.25%. Sorry, but I don't really get out of bed for 0.25%. So I like the 3x ones. And speaking of 3x ones, the next one on my list is FAS. And this is a financial sector leverage 3x ETF. And just give you guys an example of what the financial ETF is. The top holdings are Berkshire Hathaway, JP Morgan, Goldman Sachs, Bank of America, and Wells Fargo's on there, Citigroup, pretty much things like that. So it's essentially a bank ETF, and bank stocks have done very well this year. It's just a perfect storm with the falling dollar, rising bond yields, low interest rates, Powell printing all the money. Yeah, I mean, it's just a good situation. Also with falling tech, it's a good, and falling into the transition into cyclicals. I make fun of some of these sometimes, the worn out Wells Fargo stock. I specifically don't like Wells Fargo, but yeah, everybody needs banks, I guess. And we made some money on Goldman Sachs calls earlier this year. So overall, this one is chugging along. The graphs look pretty similar, and this one has done also very well. I bought it around 80, 90 this year at some point. I don't know if you guys remember that, but it was back around here, I think, during somewhere in here, and it dipped, and I was sold, and I rebought. Yeah. But nevertheless, this is a good one to have in your portfolio. Always good to keep diversified. And this one should continue doing well. It's kind of a perfect storm, in my opinion. And the last one is pretty interesting. It's called Nail. And this is a 3x leverage ETF that seeks 300% of the performance of the Dow Jones U.S. Select Home Construction Index. So as the ticker says, it's Nail, like building homes, home builders. And yeah, I don't know if you guys know, but there is a crazy short supply of homes, and the house prices are skyrocketing. The lumber, the wood has gone up a lot. A lot of homes are in high demand and short supply in urban areas, specifically Texas, like Austin, Dallas, Houston, Seattle, Denver, Southern California, as always. But there are a lot of homes that I see these days, because I'm actually in the market for some, and I see some selling for 40% over asking. Actually, I saw once, like, really, I'm not exaggerating, it sold 40% over asking, and it sold in 3 days after it listed, which it's 40% over asking. That's crazy. That's literally just super crazy to me. But hey, it is what it is. It's a perfect storm. The economy is opening back up. Inflation scares. The dollar is falling. Nobody wants dollars. People want stocks. People want to put their money into some CDs. I guess older people like CDs, or buying houses. So I think that this is a great opportunity to buy into this Nail. It's a 3x leverage. I wouldn't put as much into Nail as I would into UDOW, for example, or even FAS, because those are going to be a lot more diversified. And FAS, I mean, these are some big bank stocks. I mean, this is not really anything to be scared of here. We are all familiar with it. And UDOW is, I mean, that's Dow Jones Index. But nevertheless, this is an interesting position to be in, and it's shooting up. I think if you could afford to hold this for the next year or two, before a real estate crash, which could be in 2023. I mean, that's what I'm hearing. That's how I also feel, and especially the Fed is signaling that they probably were going to raise the interest rates in 2023. That probably going to be a hard year for investors. But nevertheless, guys, let me know what you think about these leverage ETFs. If you don't like them, if you like them, if you're going to do it, if you're not going to do it, let me know. Follow me on Twitter, subscribe to the YouTube, smash that like button. I need 1 million likes for $1 million. It's a crazy year. I mean, we're doing all right. We're beating inflation, making some gains. Even if you're only breaking even, I mean, it's not bad. Remember, guys, we have the webinar on for our stock options and investing 103 class. is going to be on Sunday 9 a.m. EST. So don't forget, I'm going to be sending out the Zoom links for that. If you guys have any questions, send me an email, and I will see you on the other side. Peace.